All right, welcome back to another week of KNR 455. This week, our topic is going to be over financial risk, which is an incredibly important concept for sport management practitioners to not only understand but be able to apply in the mitigation of risk for their sport organizations. So, just like we always do, I want to start with why. Why might this topic be important for us as sport practitioners? Or, in other words, why do sport managers need to know how to assess and manage financial risk? Well, as sport practitioners, it is ultimately your job to minimize risk for the organization, right? Now, when we talk about risk or think about risk for a sport organization, we probably initially think of physical risk, right? And how, as practitioners in this industry, it's really our job to make sure people stay safe, right? That we provide a safe environment for patrons, players, employees. So I think often we think about risk in the physical form, and certainly that's an important category of risk for sport managers to assess and manage. But there are other categories of risk for us to consider as sport management practitioners. If you worked in communications for a sport organization, you're going to be concerned with managing risk to reputation, right, or the brand image for the sport organization. But ultimately, at the end of the day, as sport practitioners, it's also our job to properly care for and protect our assets and resources so that we can reduce risk of financial harm. So that will be, obviously our main topic of risk today is focusing on assessing and managing financial risk. Okay. Obviously, we know that risk is inevitable, regardless of which sector of the industry you go into, regardless of what sport organization you're employed by. That sport organization is likely going to face some sorts of risk while you're working for them. Now, the volatility or the amount of risk they face obviously will probably vary based on the kinds of financial investments they're able to make. But regardless, risk is inevitable, and there's certainly, as we're seeing right now, major financial risks that sport organizations have to face on a daily basis. And oftentimes, the things that end up impacting them financially are out of their control. And what we're starting to see is those sport organizations that took the time to properly plan for and mitigate risk before it became an issue are the ones that are doing okay during this pandemic, for instance. You might have seen this. Wimbledon, the tennis tournament, had been purchasing and paying for a pandemic insurance policy for several years leading up to COVID 19. It had been a pretty sizable investment they were making each year, but ultimately led to them getting a $141 million payout because of that policy. So I use this as an example as we're thinking about this concept of financial risk and how it is possible for sport organizations to make decisions in terms of planning and management that might mitigate risk for their company down the road. Okay, we need to cover a few definitions here just off the top. So let's start with the concept of financial risk first. You probably have a pretty good idea what this is already based on these previous slides, but basically what we're talking about is the possibility or uncertainty of a return and the potential for financial loss. Okay, so pretty standard definition there in terms of financial risk. Again, this is something that probably all sport organizations are considering or thinking about at some point throughout the year. And we're going to look and identify a number of different types of financial risk here in a minute. But before we do that, let's kind of shift our thinking a little bit and look at this other definition, which is financial risk management. So we know that there are going to be financial risks that our sport organization faces, but we also know that we can employ some kind of risk management to try to mitigate those risks, right? So financial risk management is a process that enables an organization to reduce failures and increase profitability by carefully evaluating the risks they are exposed to and developing strategies to manage them. a big part of our conversation this week is going to be focused on this concept of financial risk management. What can we do as sport management practitioners to try to minimize and mitigate the financial risk that our sport organization is dealing with? So as we look at and identify these different types of financial risk, we'll also open up the conversation to how can we look to minimize these particular categories. Okay, speaking of, there are 5 types of financial risk that we're going to examine this week. We'll spend a few minutes on each, just kind of defining them, and then I'll try to give you some examples of each in the sport industry. And then we'll also sort of think about how these apply to some specific scenarios, and we'll work through some practice cases together. Okay, so our first category of risk or type of risk that sport organizations face is what we call liquidity risk. So this term liquidity should look familiar from our financial ratio unit that we just covered. Again, we define this concept of liquidity as basically the ease at which a company can turn its assets into cash quickly, right? And we know that in order for a company to have sound financials, they need to be fairly liquid, right? Meaning that if something were to happen, say a pandemic, that they would be able to turn their assets into cash in a fairly short order in order to sort of weather the storm in the short term. So when we talk about liquidity risk, basically we're looking at the level of liquidity for a particular company. So we can certainly identify their liquidity ratio. If it's a company that's publicly traded, we can assess that ratio, and that can tell us kind of where a company is in terms of liquidity health. And why is this an important risk for us to consider? Well, in order for a sport organization to be able to plan for the future, they have to be able to have liquid assets in the present, right? And particularly if they're looking to add additional financial risk, let's say they're going to make an investment in a new piece of real estate, or they're going to take on a new facility construction project. Before they were to make that additional investment or take that additional financial risk, they'd want to make sure that their current assets are fairly liquid and that they are sound from a liquidity ratio basis. One particular issue in the sport industry that can impact liquidity is the seasonal nature of the industry, right? Think about the different sport organizations you've interned for or worked for at some point, or even your GA. They're not playing games 12 months out of the year, probably, for the most part, right? Few exceptions to that, but for the most part, sport organizations are going to have months where they're bringing in the bulk of their revenue, right? And other months where they're just simply not generating the same level of revenue. So that seasonal nature does impact the liquidity of an organization, right? Because they might have a little bit more in terms of cash during the months that they are in business, and then in those off months, the cash line of their balance sheet is not going to be nearly as high, and the inventories may be even higher. So, companies that are seasonal in nature need to be able to plan for these things, and certainly assessing liquidity risk is a component of that. Okay, so what are some methods for reducing liquidity risk? Well, there's basically 2 ways of looking at this, right? We can look at reducing liquidity risk in the short term, which would certainly get us out of any issues maybe in the current time, but we can also think about long-term reduction of liquidity risk. So we'll take these one by one. In terms of short-term reduction of liquidity risk, obviously one great way to increase liquidity is just to sell assets, right? Assets that may not be quickly turned into cash, right? So getting rid of some assets that maybe aren't being utilized properly. Paying down debts, right? We know that we get the liquidity ratio by considering both liabilities and assets. So if a company has large sums of debt that they're incurring, maybe paying down some of that debt will alleviate some of the liquidity risk. And then, another very short-term way to reduce liquidity risk would be to identify some short-term sources of revenue. So if you're a company that sells merchandise, maybe that's discounting products, having some kind of promotion, coupons, sampling, some kind of short-term promotion that will boost sales in the short term. So those are some short-term methods for reducing liquidity. Again, probably the sport organizations that are managing liquidity risk the best are the ones that are thinking about it from a more strategic standpoint, right? Thinking about long-term management of liquidity risk so that they don't have to utilize those short-term solutions. So just, better resource allocation is a great start, right? Thinking about the assets that you have and how you are allocating those assets, doing so in a more efficient manner can certainly be one way to manage liquidity risk long term. Another one is just simply identifying more long-term sources of revenue, right? Or more sustainable sources of revenue. This one's particularly important for those seasonal sport organizations that we mentioned. I'll use the golf course that I used to work for as an example here. The golf course I worked for is Quail Meadows Golf Course. We were a Park District golf course. Typically we were only open, kind of spring to fall, and then we shut down during those winter months. But we were, running into some financial issues with that because, again, we just sort of sat with our doors closed for that period of time and weren't generating any revenue. So what we ended up doing is we identified that we could utilize a space that we weren't currently using at our facility and turn it into an indoor golf center. We were able to open this indoor golf center for basically 4 or 5 months out of the year when typically we had been closed down, right? So now we had identified another line of revenue that would help sustain us in terms of an annual revenue generation standpoint. And this ended up being a really successful investment and helped us to manage that liquidity risk, right? Because now we weren't running into those seasonal issues of downturn when it came to revenue generation. Okay, so our next category of risk here is what we call operational risk. So basically what we're talking about here is any kind of risk that comes up through or as a byproduct of the company's ordinary day-to-day business activities, right? So operational risk encompasses a lot of different types of risk, as you can imagine, and I've listed some of the kind of subcategories here, right? So if a sport organization faces a lawsuit from a patron, right, someone gets injured while attending one of your games at your facility, this would be an operational risk that the company faces. And obviously, sport organizations that open their facilities up to fans and patrons, they're consistently, assessing legal risk from a patron perspective. There can also be operational risk in the front office, right, with personnel or employees. So there could be a variety of risks that come from what's happening in your front office. There can be policy-based risk, and then there can just be general risks associated with the day-to-day business decisions that are being made. So there's a lot that's covered here under operational risk. How do we manage this from a management perspective? Well, the truth is a lot of these operational risks can be avoided, and especially important at this point for a manager or practitioners at the management level to be attuned to what's happening within their organization, right, and their day-to-day business functions. If they are, then they're probably going to notice some of these things before they become a problem. If they're not, they might be unforeseeable risks and it may be too late. Give you a kind of a good example of an operational risk here recently. So you might have seen this story, the Dallas Mavericks, the NBA team. There was a big article in Sports Illustrated where a number of the female executives that work for the Mavericks spoke out about kind of several years of sexual harassment that they faced and really a culture that sort of encouraged this sort of behavior within the Mavericks front office. And of course, the well-known owner, Mark Cuban, ends up getting sanctioned for this, ends up paying a pretty massive penalty and fee because of it, and there's a big investigation. And again, there's a lot of people at the top in that scenario that basically just didn't know these things were happening, or at least claimed to not know these things were happening. And if there is, some awareness of what's happening in the day-to-day in the front office, that those things are probably nipped in the bud before they become a problem. Another way to sort of manage operational risk is basically just having general risk management practices. In the same way that you might have a risk management plan to assess physical risk of your facility, there should also be risk management practices applied to your general operations. So whether that's having a committee that's consistently assessing operational risk, or bringing in an outside company to assess operational risk, some kind of general risk management plan practice should be in place. Okay, another type of risk for sport organizations is market risk. So if you think back to our very first lecture in here, we talked about how there are a number of external factors that can impact the financial health of a sport organization. And basically what we were talking about when we had that discussion were market risks, right? So basically changing conditions in a particular marketplace in which a company competes for business. Again, these are risks that are happening within the industry, but ultimately are happening kind of outside of what the sport organization can and does manage, right? So these are external risks within the industry. Obviously, a number of different examples here of market risks. Legal and political implications, when the government passes new laws and those change the way a sport organization is able to do business, that's a pretty substantial market risk. A couple years ago, the federal government passed a new tax law, the Tax Cuts and Jobs Act, which had and is still having major financial implications on several sectors of the sport industry, right? Because it essentially changed the way in which donors could deduct donations they were making to sport organizations, and also changed the way in which businesses could deduct any kind of spending on sport endeavors for clients. So that's a great example of a legal change that ends up being a pretty big market risk for sport organizations. Obviously, the economy as a whole is kind of a constant market risk, especially for sport organizations. Again, we're kind of going to see that play out probably in the next 3 to 5 years as this new recession has an impact on folks' ability to purchase tickets to sporting events. Consumer behavior in general is a great example of market risk, right? The level of interest consumers have in sport product is going to play a role into whether or not business is good. And then just the competitive landscape in general, right? So what your competitors are doing and how that impacts your ability to generate revenue. Now keep in mind, a lot of these market risks we don't really have much control over in terms of being sport practitioners, right? We can't necessarily change the federal government's mind when it comes to passing laws, right? We don't have that kind of power. But what we can do is kind of be prepared to respond or react. And in a lot of cases, the organizations that end up doing well are the ones that have forward-thinking business practices, right? They're thinking about the impact of these risks as they're arising, and then they're changing policy or they're changing the way that they do business as a way to try to prevent the market risk from actually impacting their bottom line. Give you another example here of kind of how sport organizations can minimize market risk. And we already identified this concept of forward-thinking business practices. And I think a great example of sport organizations doing this or applying this is we're seeing kind of play out in college athletics departments across the country, right? The issue or potential market risk is kind of this change of consumer behavior, right? We have fewer college students attending sporting events than any recent point in history. So this is certainly a risk for sport organizations at the college level, right? Because they rely on student attendance, not just for revenue, but also, to have a great atmosphere for their teams. So you can kind of see here in these headlines some examples of forward-thinking business practices, right? Schools shifting to mobile exclusively in terms of ticketing to get students in the door. Different athletic departments adopting a subscription-based model to try to draw in students. This one's always popular, right? Adding alcohol. And we've seen that even here at Illinois State. So selling alcohol at the games is another way to try to minimize the market risk of students becoming less interested in college athletics. So I use that as an example of where we kind of can see how some sport organizations are sort of reacting or trying to prevent this from being something that impacts their bottom line down the road. Another sort of way sport orgs can minimize market risk is obviously just looking around and learning from industry failures, right? What have other organizations tried? What has failed? And how can we make sure that we're not making those same mistakes? Another great way to sort of assess or minimize market risk is to minimize your other financial risks, right? So if we're concerned about something like this pandemic impacting, our ability to do business down the road, what are some things we do have control over, right, in terms of minimizing financial risk? So we can control some of our liquidity risk. So can we sell some assets? Can we minimize our debt, start paying off some of our debt so that liquidity risk is not a problem? Because we know we're probably going to have to weather the storm when it comes to market risk. So that's another example of how sport orgs might be able to minimize market risk. Okay, so this next category of or type of risk is investment risk. So as you can probably imagine, here we're talking about probability or likelihood of occurrence of losses relative to the expected return. So obviously here we're talking about potential investments and how risky or rather the level of risk that might exist for a sport organization that's looking to make an investment. So what are some common examples of investment in sport? A big one for professional sports teams and some college teams are sort of equity investments, right? So investing savings into a bank account or the stock market, bonds, whatever it might be. Another common example of investment in sport is asset investment, right? So investing in a piece of real estate or investing in equipment or facilities. So a lot of what we invest in the sport industry is actual assets. And you could even consider, athletes themselves to be an asset, right? For the professional teams, at least, they're investing in that annual salary or a 5-year contract or 10-year contract for a player. So there are several examples of investment risk in the sport industry, so it's important for us to be able to assess this type of risk. And we'll talk a little bit now about this relationship between risk and return, and we're also going to learn how to calculate rate of return. Okay, so before we calculate rate of return together, I want you to be aware of this relationship between risk and return, or what's also known as a risk-return trade-off. So basically, it's this principle that potential return rises with an increase in risk. So basically, according to this chart and this concept, any invested money can render higher profits only if an investor is willing to accept the possibility of losses, right? So we can see here, basically, the greater the risk, the higher the return, the lesser the risk, the lower return. You can apply this to a number of things in the sport industry, but certainly, investing in, a top-notch player for your team and signing them for, a 10-year max deal, you're talking quite a bit of risk, right? In terms of financial risk, you're hoping they don't get injured. You're hoping, they haven't hit their peak and are going to continue to play well. So with that great risk, in terms of a financial investment, also comes the potential for a higher return. Right? You're not playing it safe by picking someone that's a lower financial investment, right? You're willing to take the risk because you know that the return is higher. So important to kind of understand this relationship between risk and return as we think about this concept of investment risk. Another way to consider this risk-return relationship is to think about, companies investing in sport-related properties, right? So you might remember this company from a few years ago, 84 Lumber. It was this company that purchased a $15 million spot during the Super Bowl. So this is a company that basically no one had heard of prior to the Super Bowl. They're willing to invest what's probably more than they ever spent on ad buys before in this 90-second Super Bowl advertisement. And I'm not going to read through all this, but you can see that after this aired, they end up being a top trending video on YouTube. They get 500,000 more views on their website. They get this basically increased traffic coming their way, people trying to find out more about this company. And this is a great example of the greater the risk, the higher return, right? Because potentially that could have been a failure, right? They could have aired that ad. No one might have paid attention. There's no traffic on their website, and that's a pretty big risk. But in that case, the greater the risk, the higher the return, because it did pay off. Okay. So how do we measure investment risk? So now we're going to actually look at a formula that will allow us to assess what we know as rate of return, or rather the gain or loss of an investment over time. Okay, so this is a formula you're going to need to know and that you're going to need to remember for the midterm. I'll tell you right now. So the formula is pretty straightforward. We've got rate of return equals amount received minus amount invested divided by amount invested. So I'm going to do a couple of practice cases here just so that you can see this applied in real time. So here's our scenario. Team A sells for $950 million in 2020. The owner of Team A purchased the team in 2005 for $700 million. Calculate the rate of return on this investment. Okay, so we know we want to start with the amount received. So the amount received in this case was $950 million, right? Because that's what Team A sold for. So that's how much is coming in, amount received. And then amount invested, we know that initially the investment was for $700 million. So that's amount invested. And we want to divide that by amount invested, which is also $700 million. So do a little math here. Of course, at first we want to subtract the amount invested from the amount received. We know that leaves us with $250 million. So if you stop there, you would say, well, that's how much profit Team A owner made, right? But we don't want to know how much profit they made. We want to know the rate of return, right? The gain or loss of an investment over time. So we're going to take that $250 million and we're going to divide it by the amount invested, which was $700 million. That's going to give us something that looks like this, right? 0.357. Now you can report rate of return as a ratio like this, but what I would like you to do, and what is most commonly reported in terms of rate of return, is a percentage. So you take whatever you get in terms of the ratio, which in this case is 0.357, and all you have to do is multiply it times 100, and it will give you a percentage. Okay, so in this case, we see that the rate of return for the owner of Team A was 35.7%, right? So we can tell a couple of things from this, right? First of all, we can tell that he did get a return on his investment, right? Because this, his or her, I should say, this is a positive number, right? So we know that there was a positive return on the investment. We know that not only did team owner A make their money back, right, from their initial investment, they also made an additional 35.7%, right? So this is a pretty good rate of return for this team owner. All right, let's look at another example here, just so that you get a little bit more practice. So the owner of a youth sport facility just sold the facility for $650,000. We also know that the owner spent $800,000 to build and construct the facility in 2015. So calculate the rate of return on this investment. Now you can probably already tell the situation here is not as good as the last situation, but let's still plug in our numbers. So we know that the amount received was $650,000, right? That's what they sold the facility for. We know that the amount invested was $800,000, right? And then, of course, we want to use that as our denominator as well. Do a little math, we find that actually there's a loss, right? So when we subtract amount invested from amount received, we get negative $150,000, right? because they sold it for less than they paid for it. Then we want to divide that number by our denominator, our amount invested. That's going to give us something like negative 0.187. Okay, again, in order to state this as a percentage, we just multiply that number by 100. That's going to give us negative 18.7%. So again, we know with rate of return we can assess either the gain or loss, and in this case, there was a loss, right? This owner spent more on the facility than they were ultimately able to sell it for a few years later. So in this case, the rate of return is an actual loss of 18.7%. So you would just want to make sure that you include that negative sign or that minus sign in your actual display of the answer. Okay, I've got one more practice case for you to do. So I'm going to give you the chance to pause this if you want, and then try this one on your own. And then you can come back when you're done, and we can work through it.